everyone, welcome back to the channel. Today I want to react to a video from a up-and-coming finance YouTuber, Sasha Yanshin, I'm not sure how to say his last name exactly, but he is a YouTuber based in the UK if I'm not mistaken, and he has a lot of good investing content from what I've seen. So I wanted to react to one of his newer videos. The title of the video is called Investing is Like Poker. That title is intriguing to me, so let's go ahead and react to it.
Hey guys, it's Sasha. Today I'm going to share something pretty important and I hope quite interesting. This is a lesson about investing strategy that I feel can really change how you think about making investing decisions, and I think you might think about a few things slightly differently when you've heard. And there are a lot of different important points throughout this. This is not just one lesson, so listen through the whole thing. The lesson is called Investing is Like Poker. But it doesn't matter whether you're a seasoned poker pro or if you've never played the game before. That is not what this video is about. Because poker has many of the same upsides and downsides as investing. And there are some interesting things that you can see really clearly when you're talking about a game of cards that are perhaps not as clear when we make our investing decisions. Poker is a game that has a perfect numbers-based theory and numbers-based outcomes with very imperfect and very limited data available to us when we are playing the game. Having a pair of queens is a really great hand when you're starting out each hand, and you have a very large chance of winning the pot. But as you play, you have no idea what any of the other people around the table are holding, and you also do not know what the flop, turn, or river cards will bring.
Okay, I'm going to pause it right here because I think what he's getting at with this analogy is something having to do with probabilities and kind of not knowing the future outcomes. But you, in the poker world, you really do know to at least a certain extent what the future outcomes might be. If he used the two queens example, if you have two queens, that means that at best, one other person will have two queens, and at best, you're only going to see two more queens on the actual community cards that everyone can sort of play from. But that might be splitting hairs, and I don't want to front run his analogy, so let's see where he goes with it.
You also don't know what the psychology is going to be around the table, how people are going to play, etc. Because as you play each hand, new information is constantly revealed to you all the time, and that can help you make better decisions than what you can make just at the beginning. You can see patterns in what the other people are doing, how they're betting. You have the three cards that will be shown in the middle of the table that could make things much better or a lot worse for you depending on what they are. And this is exactly what happens with investing. And you have to take note of these three cards. If the turn is telling you that your king queen suited has no chance of collecting anything, then your cards don't look as good as before you saw that extra information, and you will have to adjust your strategy. Maybe you have to sell out of an investing position because new information that you've just come across completely changes your perspective, and you have to be open to your perspective changing.
Okay, now that makes a little bit more sense. We're talking about the shifting environment, and that as the circumstances change, your investment decisions should probably also change or may also change. You have to be ready to pivot when new information arises, which makes sense. And you could really say that about just about anything. As you get more information, you're going to change your decisions accordingly if it makes sense to do that.
It might tell you that your previous thesis no longer stands. You might also, on the other side, double down and invest more if the new information on your king-queen suited brings up a jack and 10 of exactly the same suit. And that might tell you that you could possibly be onto a big winner. And from the outside, many people who don't play poker would perhaps say that it is just gambling. It is just a game of chance. And if you play poker, you would know that to some degree, it is true. Chance does have a big role, just like the stock market will do whatever it will do whenever it wants to do it. But underneath that, the numbers are the difference between pro players who make a lot of money and beginners who lose every Friday night. In the short term, psychology can be the reason why you win a hand. You might have read a tell, you might have sensed that your opponent was nervous, or maybe you saw them being indecisive, maybe you saw something in their eyes, maybe you heard a nervous tap of their foot under the table, or got some other bit of data that other players did not. And you can win a hand just on that psychology. You can win a hand just by having these little snippets that give you the upper hand. But if you want to win a big poker tournament, or if you want to win consistently week after week, month after month, and year after year, you will need to learn how to play the numbers. And you'll need to learn exactly what the probabilities and distributions look like in different scenarios with different cards on the table.
So, okay, we're adding another layer to this analogy, and I think probably the best way to paraphrase this would be you have market sentiment, or just sentiment-based investing, and actual logical, numbers-based, probability-based investment strategies, which Sasha's arguing would do better over the long run. I would tend to agree, since it's very hard to try and guess what human emotion will be, at least over the long term. In the short term, yeah, if you have some sort of informational edge or someone has a tell, and that can be something that you could capitalize on in the short term, but typically over the long run, you really want to place higher probability bets based on your own competence, whatever you think a high probability bet would be. That's going to change for every person. But if you can make a lot of these higher probability bets, you're probably going to do pretty well over the long term. But in the short term, anything can happen, which I think is really what Sasha's getting at.
And you'll need to learn exactly what the probabilities and distributions look like in different scenarios with different cards on the table. And it's the same exact thing with investing. You can make a short-term trade because you feel you know something that others don't, or you see the data differently. You might be able to get a big win as a result, and that could well happen. But in the long term, fundamentals rule the game. Investors with a robust long-term strategy have a very good likelihood of making money. Hell, just investing in the total stock market index will on average return 9 to 10% a year, and that is not too shabby. That is actually quite good. But try going for big trades based on hunches all the time, every single day, based on guesswork, and see how far that will take you. Maybe you're going to win some, but the vast majority of people who do this, who trade over a long period of time, will lose money. You don't have to trust me. You can Google it. There's endless studies available. And out of the tiny minority that do not, out of the tiny minority that manage to turn a profit, almost everyone from that tiny segment will make returns that are less than the minimum wage they would have earned if they spend the same amount of time flipping burgers down the local shop.
Now, I tend to agree here, especially with that point that Sasha made, that fundamentals rule over the long term. As we see in the stock market, for example, typically the market will kind of revolve around its fundamentals, the earnings of the companies within it. And that goes for individual companies, goes for the market as a whole. That's why when you see wild swings up or down, typically it follows that general trend line of earnings increasing and the actual companies underneath the market becoming better and better. That's typically what drives the market forward. But in the short term, you see a lot of sentiment driving things, and that is very hard to predict, which in the same way as poker, that is also very hard to predict and is not really a reliable strategy for the vast majority of people, other than those maybe who are very lucky or who are generally just wizards. The only thing I don't really like about the poker analogy is that the poker universe is fixed. There are only 52 cards out there, whereas in the investing world, there are a lot more different ways that outcomes can be changed. It's not as though you know going in that there are only this many cards out there. I've seen these cards, so you have this fixed amount of data left to be exposed. In the investment world, with humanity moving forward as it always does, there are lots of different things that could change. And it could also move backwards in a terrible way too, at least in the short term. You never know when those things are going to happen. That's where real life is very different than something like a fixed game like poker, where there are only so many different outcomes out there. There are plenty of outcomes, though. It's not as though it's super easy to predict in any given case. But what I'm really getting at is that generally in the investing world, there are a lot more different outcomes that you could possibly experience versus in the poker world, where there are just many less types of outcomes that could possibly happen.
Poker is a game of hands. At the beginning of each hand, everyone around the table is equal. Now, players might have different numbers of chips and might have different amounts of money they can play with, and the order around the table changes, so there's slight advantages and slight disadvantages to some of the players, but that's pretty much it. Then you play a hand, and you either decide to play or pass. And most of the time in poker, when you assess your hand, you will choose to pass because you don't feel it is a good enough investment. And if you play, you will either win or lose that particular hand. But once that hand is over, the next one starts and everything starts from scratch again. You might have slightly more or slightly less chips, but you have to play the exact same game and use the same strategy. Investors often fail to recognize that investing works in the same exact way. You go and pick on a company that you want to invest in. You've probably looked at dozens of other companies first, but then after doing your assessment, you decided it wasn't worth putting your chips in. And then you're staring at a pair of aces and you decide that now, finally, it is time to go and invest in this thing. And so you push your chips into the table. So you invest and you play out the hand. Things happen along the way. Other people are playing against you. New cards show up and they could make your hand better. They could make it worse over time. But then after all the ups and downs, in the end, let's say you win. The share price reaches your target, you don't see any more upside, and you sell up. You have completed that hand. You now have a few more chips, and you can do a bit more with them, but now you have to start again. But the game hasn't changed. You're just playing the next hand. The key to winning over time is to consistently play out a winning strategy one hand after another. Rinse and repeat.
Okay, I'm going to add another layer to this analogy that Sasha's getting at, and I'm going to actually add another analogy alongside of this. We've heard about Warren Buffett talking about waiting for a fat pitch, as in baseball, where you can stand up in the batter's box and you're waiting for pitches to go by, and you're waiting for that perfect one to hit or one that's really good, and you're going to take a totally good swing at it. You're not going to be swinging at bad pitches, because unlike an actual baseball where there's a ball and strike count and you can strike out or walk in the at-bat finish, you actually don't have that in the investment world. You can just keep watching opportunities go by, and nothing's really going to happen. Though I guess in the real world, you do have things like inflation to worry about, where your purchasing power might decrease along the way, which I guess is similar to in poker, where you have blinds that will force you to put money in every now and then, at least every few hands as the game moves along. But in general, there's no pressure to play a particular hand or go for a particular investment until you're getting into the very late stages, I suppose, where the blinds might increase a bunch in poker. But sticking with real life, there's no pressure to actually put money into any particular investment. That is totally up to you to decide on what you want to go for. So that gives you an advantage in a way of being able to wait for that really great hand, that really great investment. And as Sasha says, as you have more winning investments, winning hands, you gain more chips, gain more money, you're going to be able to play from a position of even more power and patience, because you don't actually have to be pressured to take any one opportunity. You have money to live off of, you have chips to sustain your blinds in a game of poker. You have more abilities to be patient and disciplined in your investment strategy, and that should bode well as you continue to go on through the investment game.
And you don't have to win big in the hands that you do win, but if your strategy lets you win enough of those hands over time, you are going to do pretty well. And the second really important lesson is this. In poker, the vast majority of players are beginners. Quite a few are complete noobs who barely know the rules. There are some pros out there and you can play with them, but when you play against beginners, two things happen. The first is a good bit. Numbers always win in the long run, and if you stick at it and you know what you're doing, you should win on average over time against these beginners. But playing with complete beginners is also incredibly difficult. In fact, it is much more difficult to play with complete beginners than with seasoned pros. You have no idea what you're going to do. You have no idea what they're thinking or why they're thinking it. They probably don't know themselves. You can have the most solid poker strategy out there, but you can still lose because it is impossible to predict what it is that you're dealing with, where it's going to go. You're basically playing blind. And this analogy is how I often think about people who go and try to invest in things that are very unpredictable. Things like meme stocks, meme crypto tokens, Airtime International, or whatever penny stock someone told you about. And the problem here is that we all think that we can make a lot of money from this because this is the beginner stuff. This is the stuff that goes up and down. This is the easy money. And if you play these games, you absolutely have no idea what the other side is doing. You also have no way of being able to find out. This is not a large corporation with years of history, robust data, and endless information out there from different sources. And sure, some people will make a lot of money off these plays, playing these beginners, but don't for a second think that you are going to make this money, even if you do, because you are some kind of great investor. The only real reason is going to be luck.
Okay, I actually do like this a lot. And the idea being that if you're playing against a bunch of beginners in poker and you're using kind of a seasoned strategy, playing the probabilities, it might actually blow up in your face because the strategy does revolve around other people also playing the probabilities, at least in a particular way. You might have someone come in recklessly and you're trying to guess what they have, but there's no way to guess because they're playing completely randomly, maybe completely on emotion, or just they don't know what they're doing. And it's very hard to play against an unpredictable opponent. And that's really in many different types of games and sports. So that is kind of difficult. And I think that applies to investing in the short term where sentiment drives so much of the market. And you might make a really good high probability bet that would be good for the long term. But in the short term, it ends up being a disaster. And if you need that money anytime sooner than your long-term probability says you'll need it, you're going to be in a world of hurt because sentiment often drives the market in the short term.
You are happy with your choices if that's the route that you want to choose. And one of my favorite poker formats out there is a multi-table tournament. These tournaments are where a number of people all compete for the same set of prizes. Everyone pays an entry fee, and there might be a few dozen, maybe even a few hundred different people playing on many different tables, and this takes a while. But as players are eliminated as the game progresses, eventually a small number end up on the final table, which is where the big money is won. And the reason I really like multi-table poker tournaments is because they add a whole new strategic element to the game above and beyond normal poker. You have to plan and you have to be very calculated with your strategy. The way that you play at the beginning of one of these tournaments is completely, or at least has to be completely different to how you would play on the final table. And it's almost like you're playing two different games when you consider those two things. The people who do particularly well in these tournaments know that, and they apply it. You'll have someone who doesn't play a single hand for the first hour or maybe even two of the tournament, just sitting there and watching. But then that same player will be the most active player on the final table. And as an investor, this lesson of having a long-term strategy where you have to play differently at different points is incredibly important. There will be times where, as an investor, your strategy is just to sit tight, do nothing, wait some more. And that is going to happen a lot. That should happen for the vast majority of your investing career. I mean, sure, put in some extra money every month if you have it, all of that, but more times than not, the right strategy is just to hold and wait. But then something will happen. There will be a moment of panic. The markets will turn red and crash to the floor, or new legislation happens, or who knows, anything can happen. And then the strategy that you want to play at that point will be, and in many cases should be, completely different. Sometimes you will have to turn from the guy who has done nothing for a few years to the most active player, especially if you've decided what your strategy will be in that particular scenario in advance before it happens. You know, while you were sitting there doing nothing. I hope you found this one thought-provoking and useful. If you have, please don't forget to smash the like button.
So that's a very nice video by Sasha. I enjoyed that one. I guess just to wrap up with that final point about kind of playing a different game based on the time you're in or based on the events that are happening, being ready to play different strategies at different times. I think that goes along with the fat pitch strategy where you don't have to swing at the things you don't want to, but still you have to have the discipline to actually pull the trigger and take a swing when you get a good pitch, because that's important too. You can keep watching them go by, sure, but eventually you're going to want to take a swing at one of those good pitches so you can actually start building your wealth. So not only do you need patience to wait for the good opportunities, you also need the discipline to act on those good opportunities when you get them, which is easier said than done. And you can pretty much apply this to any asset class, whether it be stocks, real estate, whatever it is, building your own business even, deciding on when to take action in certain market segments versus not. There are lots of different ways that this sort of analogy of waiting for the opportunity, playing the odds, where this really does apply. And I think Sasha did a good job of breaking it down. So if you guys haven't checked out his channel already, go ahead and do that. He does have a lot of good content. I've started to go through some of it in the last couple of weeks, and I have enjoyed what I've seen. So best of luck to him as he continues to catapult his YouTube subscriber count. Anyways, if you guys like this video, please like it since that would help the channel out a lot. And if you want to see me react to another video, definitely let me know in the comments below and I'll do my best to get to it. And be sure to subscribe since I put out new videos every single week and wouldn't want you guys to miss out. But until next time, take care.